Boom shakalaka, Bitcoin broke down exactly as anticipated in yesterday's video. Today we're going to take a look at what this means for Bitcoin, altcoins, NFTs, and you. And we're going to take a look at how to win at cryptocurrency based on strategies from one of the best investors of all times. Stay tuned. What's up everyone, Randall here from Crypto Love. Today's video, we're going to take a look at Bitcoin breaking down out of its bullish pattern, what this means for you, plus how to win at cryptocurrencies based on one of the best investors of all times. Before we get into it, guys, make sure to like, subscribe, click the notification bell. Also, come join us over on Twitter at the Crypto Love. And today's video is sponsored by vaultdefi. Stay tuned until the end for a sponsored review. Now, we're going to take a look at Bitcoin. But before we take a look at Bitcoin, let's take a look at some of the news about Bitcoin. It seems here that institutions remain bullish on Cardano and Ether while BTC outflows persist. As a matter of fact, if we take a look at this document, they're referencing this CoinShares digital asset funds flows weekly following a 6-week run of outflows. The positive price action has now pushed total assets under management to $57.3 billion, the highest since mid-May. Solana, a competitor to Ethereum, saw the largest inflows of any digital asset last week, totaling 7.1 million. Ethereum saw minor inflows totaling 3.2 million last week, along with other altcoins such as Cardano, Litecoin, and Polkadot, which saw inflows of 6.4, 1.8, and 1.1 million respectively. Bitcoin, however, saw its 7th straight week of outflows totaling $2.8 million. It seems like money is flowing into Solana, into Ethereum, into Cardano, Litecoin, Polkadot, and flowing out of Bitcoin. Does this make sense? Well, it certainly makes a little bit of sense. The market is, oh, you could say frothy. You can feel it. Because guess what? Bitcoin has been around for a while, and people kind of understand Bitcoin, but it just doesn't make you money fast enough. I mean, going up 50% in the past month, not fast enough. You need NFTs. You need to be able to buy a JPEG for $1,000 and sell it for $1 million in a week. And it could happen. I mean, this is something that I don't truly understand, so I will admit that. However, once buyers disappear for NFTs, the floor goes out. I mean, if nobody's going to buy it, you're stuck with a JPEG. That's my thoughts on it. I could be wrong. I could be wrong. Because here's something. So I like to read. Aside from making YouTube videos, I really like to read. I just finished reading Anti-Fragile. There you go. I just rub it in your face that I can read long, boring books. I actually listen to it. But it was actually a really good book. And one thing that I got from it was the Lindy effect. So this is different than what we think. So regular in Gaussian distributions, the young is expected to live longer than the old. This is true in humans. Young person expected to live longer than the old. However, exponential distributions, both the young and the old have equivalent life expectancy. But in technology, there's something called the Lindy effect, which is a power law, which is the old is expected to stay longer than the young in their proportion to their age. And I think this is something that people kind of miss out on in cryptocurrencies because they want the next Bitcoin, the next Ethereum, the next this, realizing that each one of these things holds a much greater risk of not sticking around. I mean, guys, when I started making videos about cryptocurrencies, there were 800 cryptocurrencies. Now there's over 10,000. And guess what? Still only 100 on the first page of CoinMarketCap. So those ones don't stay around. But you know which ones have been on there forever? Bitcoin. But if you want to make money fast, clearly you can't put it in Bitcoin because 6 years isn't fast enough. You need it this year. So that being said, there's my little standing on a podium or whatever and saying that. Now, Bitcoin has broken down. This could potentially look bad for Bitcoin. We talked about how Bitcoin has been in this downtrend. We were hoping that it might break out of this downtrend, but it didn't. It broke back down into between this red downtrend and this green uptrend. So we're still just unknown. Now these lines here, we have the golden cross and the death cross. We just had a death cross that happened back on June 20th. It looks like things are approaching a golden cross. Now this is a lagging indicator because the death cross, something signaling something bad, actually happened at around $33,000 and Bitcoin price really only went down to $30,000. So the death cross pretty much signaled the end. Could the golden cross signal the beginning? Or could it signal the end there as well? We'll kind of have to see if this keeps going down. Now, if we take a look not at the Bitcoin charts here, but at what's going on underneath, because Bitcoin is different than a lot of other technologies where we can actually look and see on-chain data. So, first thing, Bill Noble, you guys know him, I've interviewed him many times. He says he's truly surprised that Bitcoin could not move to 55K. What's worth noting is that the range is compressing. A push through 50,000 would obviously improve the picture. Approaching the US Labor Day holiday, the $44,000 and $46,000 levels are support if there's a dip. So you can see the price compressing here, not as volatile. Potentially we might see $46,000 to $44,000 as support, and that looks to be where Bitcoin is headed. As a matter of fact, the MA200, the 200-day moving average, is right at $46,000. So I think that would be a very reasonable area. But if we take a look at things like supply shock, like the amount of available Bitcoin, okay, this wave of Bitcoin supply shock has the most momentum of any in recent history. We're going much higher over the coming months. You can see down here the supply shock. Every time we have increasing supply shock, generally after it peaks, the price goes up significantly. Now this is great news. However, because we like to look at both sides of the picture, I will say there were some responses. This guy here, Leverage Monkey, says that Bitcoin is missing over 300 whales from the peak. They weren't even interested in buying back at 28,000. The supply shock is being perpetuated by the exchanges and miners holding Bitcoins. It's an experiment and they will dump if it doesn't work out, so cut the crap, tell the truth. Potentially, this is supporting this idea that a lot more money is going to these newer blockchains like Solana, Ethereum, Cardano, Litecoin, Polkadot, as opposed to Bitcoin. Possibly. Now, the other friendly reminder that we have, because we have to try and get the whole picture so we can see all of what's going on, friendly reminder that Bitcoin is in one massive ascending channel that will likely break to the upside. As you can see here, nice ascending channel. Turns out, as you read up here, ascending channels have a 68% chance of breaking to the upside. Good luck on being short the hardest asset in history during the greatest period of asset inflation in history. That's right, 2 out of 3 times it breaks to the upside. 1 out of 3 times it breaks to the downside. Well, right now, they're printing a lot of money. Bitcoin, aside from Ethereum right now with EIP 1559, is pretty much the hardest money that's ever been around. Maybe that's why people are going from Bitcoin to Ethereum, because they realize Ethereum just had 3 halvings simultaneously with EIP 1559. But maybe we're undervaluing Bitcoin because it's just not moving fast enough. You see, it turns out that right now there's over 2 times the number of calls over puts on Deribit. Open interest put-to-call ratio is at its lowest since the end of December 2020. So you can see here, this purple line, very, very low, hasn't been this low since December 2020. Now, if we go back to the chart, just so you can know, so you can remember what happened December of 2020, that was right here, way down here, right below $20,000 before Bitcoin blew up 3xing. And I mean, Michael Saylor asked people, what's the safest place to store your wealth over the long term? You have to remember, they're printing money at lightning speed. As a matter of fact, the sure thing trade, according to Peter Brandt, maybe commodities go up, maybe down. Maybe cryptos go up, maybe down. Maybe notes go up, maybe down. Maybe equities go up, maybe down. The only thing that is the purchasing power of the US dollar, the only sure thing is that the purchasing power of the US dollar is destined to tank. This is the driving trade. Because it's kind of interesting. We expect that this time will be different than every other time every country has printed money. It may not be different, which leads us to, where do you store your wealth over the long term? Do you put it in banks? No, definitely not. Can't trust banks. How about bonds? Can't really trust governments, can you? How about buildings? Well, real estate is historically good, but Bitcoin seems to be a lot more popular. Which brings me to this. Kiyosaki, he says Bitcoin is booming, gold is stagnant, silver is 50% below all-time highs, dollar is dropping, silver's the best, lowest risk, high potential investment. Bitcoin has the greatest upside. With dollar dropping, Bitcoin and silver are the best investments. Now, silver price is artificially held down because they need to use it in electronics. Bitcoin, not so much so. So of those two, definitely has some great upside to it. Which brings me to this point here, how to win at crypto. So I just listened to a book by Charlie Munger. He is arguably a genius. Now granted, he doesn't invest in Bitcoin because it's something he doesn't understand, and he freely admits that. He doesn't put his money into things he understands. But of the things that he understands that he puts his money into, he's made an absolute killing. So it makes sense to try and learn some things from this guy. So let's take a look at them. Well, I've come up with a few rules, and we're going to take a look at each of these and see how they can benefit you in crypto. So the first rule is, you don't actually need to be smart. Charlie Munger says this all the time. He says, I don't need to be smart. I just need to not be stupid. And another way to say this is that when you're looking at something and you want to know how to succeed, look for how to fail and don't do that. So that's what we're going to be doing with these rules here. Rule number 1, and this is a very essential rule. Don't get wrecked, don't get fished, don't get robbed, don't get locked out. So this rule, if you want to lose in cryptocurrency, just lose access to your cryptocurrency. If you get wrecked, if you're trading on margin and you don't know how to, you get wrecked, you lose it all, you're done. If you get fished, and this is easier than ever before, clicking on links in emails, basically clicking on links. Don't click on links. Try your best not to. Okay? If you get robbed, and getting robbed, one thing would be somebody physically robbing you, but another thing would be having your assets on exchanges and then losing access to that. And then don't get locked out, losing your private keys, things like that. All of those are ways to completely lose. And so you want to not do those. Rule number 2, don't lose money. And this is Warren Buffett's. He has 2 rules to investing. 1, don't lose money. 2, refer to rule 1. Okay? Basically, don't lose money. And this is a way that wealthy people, I have found, think of investing. This is definitely different than we see in cryptocurrency, and that's why in cryptocurrency we see these insanely frothy markets. Because in cryptocurrency, everybody wants to get rich quick. Generally, you can't get rich quick. You can get broke quick. You can't get rich quick. Or if you do, it doesn't last. Think of lottery winners. Think of MC Hammer. Think of those things. So, wealthy people, when they think about money, they think of return of capital, not return on capital. What that means is you want to make sure you get your money back, and then you want to think about your returns. So, returns on your capital, how much percentage you're making, is actually secondary to getting your money back. And this makes you think, well, maybe some of those risky speculative projects you can still invest, but invest with 1 or 2% of your portfolio. Don't go all in, because if you go all in and you lose, you are all out. On to the next one. Don't be greedy. And this is another thing with frothy markets, okay? We have some frothy markets going on right now. Don't be greedy. Bulls can make money. Bears can make money. Pigs get slaughtered. Okay, so if you are being very, very greedy, if you're always chasing the gains, always trying to get the last penny, chances are one of these times it's not going to work out in your favor. The next one is don't FOMO. So there's this saying that I learned a long time ago when I was in France, that the French woman, they would always say, you know, men are like the metro. If you miss one, there's another one coming. Basically like the subway. If you miss one train, there's another one coming. You just wait for it. In cryptocurrency, like I said, when I started, there were 800 cryptocurrencies. And this was only 4 years ago. There were 800 cryptocurrencies. And people thought that was outrageous. Now there's over 10,000 cryptocurrencies in 4 years. It's gone up that much. Well, if you miss one, there's another one coming. Like, let's say Solana is pumping this week, and you missed it. That's okay. Just wait. There'll be another one. Try and find that deal. Don't FOMO. Because when you FOMO, you buy the top. Somebody else is making money for you buying the top. On to the next one. Don't get conned. And this is an important one, especially nowadays in these frothy markets. All the snakes come out. They all realize that it's very, very easy to have an ICO and make $20 million and then leave. So the rule is, if you don't know the patsy, it's probably you. And a patsy is somebody who's very easily conned. If you can't figure out who's getting conned here, it's probably you. The next one is don't get caught holding bags. Okay? A lot of people who were in from 2017 know what I'm talking about. If you held bags from 2017, they went down 99 to 100%. Yes, one of them came back called Cardano, but that's one out of thousands of cryptocurrencies that came back. So don't get caught holding bags. Have an exit strategy, so plan ahead, and then actually implement that exit strategy when the time comes. Know when you're going to get out of the market, because that's the thing that you have to look at, the speed of money, how quickly you can use your money to make more money and then take that money before you lose it to make more money. Rule 7. This is an important one, probably the most important rule out there. Don't listen to experts. Guys, I'm just a guy who makes videos in front of my computer. I mean, granted, I've been doing this every day for like 4 years, so maybe I know a little bit more about cryptocurrencies than other people, but I'm not an expert. By no means whatsoever am I an expert. So definitely don't listen to experts, and people who tell you that they're experts, doubly don't listen to them. And then lastly, final rule, and I think this is the most important rule for when markets go up, yes, and doubly so for when markets go down, because as As excited as people get when the markets go up, they get especially more salty when markets go down. So this is the final rule. Don't lose perspective. Guys, money is one thing in life. Once you have enough money, you realize that money's not everything there is. I know you see the guys in their private jets and their Lambos and all these expensive cars and their watches and everything. It's just money. You can't take it with you. You can enjoy it a little bit, but after a while, it gets to be not that enjoyable anyways. So, what does it profit you to gain the world yet forfeit your soul? Don't lose perspective. This isn't the end. This is one cycle. There will be another cycle after that, and another one, and another one, and another one. And the cool thing is that you are in cryptocurrency still very early. This is comparable to the internet in 1997. I doubt you even remember what it was like back then. There were no cell phones. There were no iPhones. There weren't even, maybe, I don't even know if there were zip disks yet. And you probably don't even know what those are. So there's still a lot of room ahead of you. Don't lose perspective. There's a lot of room to grow. So guys, that is all for what's going on with Bitcoin and cryptocurrencies today. I think it's a very interesting times we're in for. I'm super excited. And that brings us to the sponsored part of this episode. Now, I just have to say, because it seems like there's been some confusion previously, this is sponsored. That means that while I may not necessarily endorse this project, they're paying for eyes on the product. So obviously I'm going to go over the review. You do your own due diligence before deciding to invest or not invest. Totally up to you. So vaultdefi is the sponsor of today's episode, reimagining the possibilities of decentralized finance. Welcome to vaultdefi, the next pioneer in innovative cryptocurrency investing. So Vault tokens, they have a diverse token ecosystem designed to reward with compounding interest. Every transaction in our ecosystem adds to price, volume, and burn of SafeVault and SFM. So they have a couple tokens here. They have SafeVault, the first 25.65% auto-reimbursing SFM rewarding token. It's hyper-deflationary and self-sustaining. It's designed to create daily compounding interest by growing your SFM holdings, which in turn increases reflections regarded by the token. So they have that one there. They have not had it audited yet. They also have ETHVault. ETHVault is the first 26.8 auto-reimbursing Surge ETH and SafeVault rewarding token. It's hyper-deflationary and self-sustaining. It creates double compounding interest and uses Surge ETH to provide hedged security and interest. And they have data there. It's also available on PancakeSwap, and you can actually vote on what token you would like to see next. Now, what is the Vault? It's a proprietary compound rewarding system designed to revolutionize DeFi. Innovating DeFi to its full potential, they're revolutionizing the capabilities of a traditional decentralized financial product by providing an asset class that rewards many streams of passive revenue. The proprietary structure builds within each Vault token allots you up to 4 unique tokens every time you purchase a Vault token. Double compound rewards and diversification. Inside these multiple assets, you will find yourself with 2 separate double compounding mechanisms, creating the possibility of exceptional long-term growth and returns on your investment. Our suite of DeFi products helps grow your portfolio by tapping into the unforeseen functionalities of the decentralized network. Now, the rewards and benefits, the overview of the new ETH Vault token. Vault tokens are uniquely developed to provide you with 2 double compounding features for each individual token. When you purchase one of our Vault tokens, you'll end up with 4 total assets through our cutting-edge tokenomics. This excludes our original SafeVault token, which rewards in 2 assets. Each Vault DeFi token you own nets you the Vault token you purchased, rewards in Surge wrapped version of specific coins, rewards in SafeVault token, and SFM rewards via owning the SafeVault token. And you can see all that right here. Now, their Vault Tokenomics, they have a 5% buying fee and a 30% selling fee. The mission, the Vault team is proud to bring an unprecedented vision to the DeFi space. It's our intention to provide a product that allows passive growth opportunities to those who it was previously denied. Our passion for decentralized finance is fueled by our desire to educate and bring awareness to the untapped possibilities offered by the DeFi platform. Official collaboration with Surge, so a beautiful diversified combination of hedged interest and compounding interest, and you can see a little bit more about how they interact with Surge and the benefits of Surge. It's a next level technology in cryptocurrency. No more liquidity pools, no more contract owners, no more insecurity while investing in cryptocurrency. Upward moving chart, Surge's continuous upward growth by hedged interest away from coins that's wrapped. And a downward moving chart, continuous separation on downward trend using hedged interest. So buys All buys, sells, and transfers all make the price go up. Now, they are also contributing to charities in Gambia. In terms of a roadmap, they've assembled their team: social communications, Safe Vault token; education, ETH Vault token, BTC Vault token; global exchanges, build token ecosystem, and the charity. And then with them, you can build a compounding portfolio. They provide products that automatically diversify your portfolio. These assets include rewards in multiple tokens, which reduces your risk while growing your overall position. Each individual reward contributes to the overall compounding mechanism, leading to a steady stream of passive income. You can see the dev team here with Jen, the CEO, Eric, the founder, and Mike, the other founder, and learn more about their tokens on each of the pages. So guys, that is it today for Vault DeFi. Thank you very much to Vault DeFi for sponsoring the episode. Like I said, sponsored review. Not saying buy or don't buy, totally up to you. But thank you all for watching the episode. If you did enjoy it, make sure to like, subscribe, click the notification bell, and I'll catch you later. Peace.